the run to new highs and why a growing number of market watchers say it's time to change your strategy in stocks. We're going to debate the next move for your money with our investment committee today. Joining me for the hour, Joe Terranova, Steve Weiss, Shannon Saccocia is the Chief Investment Officer at Boston Private Wealth. Michael Farr is CEO of Farr Miller in Washington and a CNBC contributor. And Tiffany McGee is with us today, the CEO of Momentum Advisors Institutional Investment Services Group. Let's go look at where stocks are currently trading. S&P going for its longest winning streak since April. There you go. S&P and Dow are positive. Dow's the big outperformer today. S&P, though, about 1.5% away from new highs. Joe Terranova, I begin with you. The question is, how are we going to get to those new highs? Value is outperforming today. Is this the start of the long-awaited rotation?
Well, you're initiating a great conversation, Scott, because as you have identified, the S&P 500 is basically sitting less than 1% above its all-time high. What's critical, though, in getting there, if you're not going to have a significant outperformance from what has worked, which is clearly hyper-growth, is you're going to have the participation from the value names. And let's put in context where value really is. Scott, the Russell 2000 is still sitting 9% below its all-time high it achieved in August of 2018. When I'm thinking about value, I also have to think about value and get contribution from small cap value, not just large cap value, because there's been such a differentiation in the small cap index this year. Small cap growth is up 22% year to date. Small cap value is down 12%. So yes, I believe it has to come, the contribution from small cap value. You have to be very tactical in how you're doing it. You have to ask yourself, where am I taking the money from if I'm allocating it to tactical value? But I also want the technical support. And there are some names that I've gotten into recently where you're seeing technical support. You're seeing some 52-week highs. But I just don't want people going out and looking at these value names that could be value traps and saying, oh, from a price standpoint, they're cheap. Let's just buy them. That is a very dangerous strategy. All
right, Shannon. So, I mean, I think this is the biggest question in the market right now. Are we going to see this great rotation from growth into value? And, in fact, is this the start of it today in what has really been a trade? Values outperformed growth in terms of the ETFs markedly over the last month. The value ETF's up 5%. Momentum's only up a quarter of a percent. Jonathan Krinsky today, a well-known technician, to Joe's point, talking about the technicals as well. Krinsky says, well, this trade has continued to struggle since the massive run-up. We think it's setting up once again. Is he right?
Well, we've had a lot of fits and starts on this trade over the course of the last year, Scott, and we've talked a lot about that. And I think, there's two parts to this argument. Is this rotation to value sustainable? And if it is, what does it need to create? What does the economy need to do to create support for it to be sustainable? And I think that's even more important. In order to have a true rotation to value and a rotation to cyclicals, which is really how we look at it, we need to have evidence that the economic recovery is sustainable. So otherwise, you will not continue to see value stocks outperform. They need a cyclical tailwind to couple with the monetary and fiscal tailwind that we've been enjoying. And so otherwise, what you're going to see here is you're going to see perhaps a pullback in mega cap tech, for instance, that offers a buying opportunity for people that are looking at a low growth, low interest rate environment ahead of us. Unless you expect there to be growth and inflation, which the yield curve would start to indicate by steepening, we're not going to see a sustained rotation to value. And so we're looking for that economic credibility to create our basis for a sustained rotation to value.
All right, Steve Weiss. Tom Lee told us on Friday this big rotation is going to happen this week. Maybe this is the start of that. Morgan Stanley's Mike Wilson says the better relative opportunity at this point is with cyclical stocks, those stocks most levered to the recovery over the next 12 months. We would look to add more exposure to that side of the barbell if the market corrects as we expect. We talked about this a lot, Steve. Whether this rotation was going to come, whether these tech stocks have simply run too far, and you need a catch-up trade, and maybe this is the beginning of something.
Well, I don't look at the overall market as cheap, but here's what I'd suggest. Rather than listen to strategists or technicians, listen to vaccine researchers. Because if you get a vaccine, you're going to see those laggards lift with, as Joe points out, regard to valuation. So price is not valuation. So I would tell you that a lot of these are already expensive. But if a vaccine happens, everything moves up. Does anybody really believe that the technology stocks, which have also been held back, I would say, in terms of the fundamentals and their earnings by COVID and the economic malaise, with the exception of the Zooms and so forth, does anybody really think they won't benefit in an economic recovery?
No, they will.
Like we saw over the last 9 years?
But what happens?
Of course they will.
But they will. You're right. Your point's well taken. But isn't there potential for more upside on the ones that have lagged? The cyclical, the value, the epicenter, the reopen, whatever you want to characterize that trade as?
Absolutely. As a trade, I agree. As an investment, if you look at a number of years, I don't think things will change than they have for the last 10 years or so. Value will be a laggard. Now, there are some that will definitely have huge moves. Those will be the airlines, the cruise ships. But then you've got to go back and say, okay, how much have I been diluted? How much has my balance sheet been hampered by this? So, yes, so I think it's a good move. It's the obvious move now. It's the move in front of the vaccine. And there's, I've increased my weighting in those stocks with the Johnson Controls, with a TriNet, with an XPO that I increased, with a UPS. So I have put that that barbell approach in. And then what really hurt the technology trade is the China relations, which continue to hurt it. And so those two things have conspired more aptly to push value ahead.
Tiff, Dow's up almost 300 today. Is this the start of something bigger?
I think everybody makes really good points. First of all, I'm not ready to, throw tech over the boat or growth. We really continue to focus on identifying other pockets of opportunity. And so, I talked about the fact that I favor, investment banks over commercial banks. And in particular, as we're having this conversation about value, I really like their diversified revenue streams, but I really like within the financial segment, outside of JP Morgan and your Goldman Sachs, if you will, kind of like the usual suspects, I really like the independent investment advisors. And so they actually tend to and have been outperforming the broader financial sector. The prices are really great. As a matter of fact, they outperformed about 14% in the second quarter. They're beating revenue expectations, and they really do have this diversified stream of revenue that is countercyclical. So I really do like those plays, and I'll give you maybe just three ideas. PJT Partners, great price, Evercore, and Houlihan Lokey.